When you run a business, one of the most important financial considerations is how to classify payments from the company to yourself. Proper classification ensures compliance with tax laws, transparency in your finances, and optimal tax efficiency. The right approach depends on your business structure as well as the nature of the payment. Let's dive into the key ways you can classify these payments, clarify their tax implications, and explain how they impact your equity in the business. Classifying payments to yourself correctly is essential for several reasons. 1. Compliance. Misclassified payments can result in penalties or audits from the IRS or other tax authorities. 2. Tax efficiency. Some payment types, such as distributions or dividends, may offer tax advantages over a salary. And 3. Transparency. Clear and accurate records enhance professionalism and make it easier to understand your company's financial health. The way you classify payments to yourself depends on your business structure. Let's outline common structures and how payments are handled in each scenario. In a sole proprietorship, or single-member LLC, the business and the owner are considered the same legal entity for tax purposes. Payments to yourself are categorized as owner's draws rather than salary. Owner's draw. This is a transfer from the business's bank account to your personal account. While the draw itself isn't taxed, you are taxed on the business's net profit, regardless of how much you withdraw. Impact on equity. Since you and the business are the same entity, taking an owner's draw doesn't formally reduce equity in the traditional sense. However, it reduces the available funds in the business, which might impact growth or liquidity. In a partnership, payments are classified as either guaranteed payments or partner draws. Guaranteed payments are fixed amounts paid to partners for services or use of capital, regardless of the partnership's profits. They are considered ordinary income for tax purposes and are reported on the partner's individual tax return. Partner draws, on the other hand, are distributions from the partnership's profits or capital. Unlike guaranteed payments, draws are not taxed directly because the partner's share of the partnership's profits is already taxed. Draws directly reduce a partner's equity in the business. Equity represents the partner's ownership stake, calculated as their initial contribution plus retained profits minus any losses or withdrawals. For example, if a partner's equity balance is $50,000 and they take a $10,000 draw, their equity decreases to $40,000. This reduction means they have less claim to the partnership's assets or future distributions. To avoid disputes, guaranteed payments and draw rules should be clearly outlined in the partnership agreement, including how equity adjustments will be calculated. Multi-member LLCs work similarly to partnerships. Members receive payments as distributions or guaranteed payments. Distributions are payments from the LLC's profits. Members are taxed on their share of profits regardless of whether they take distributions. Guaranteed payments are fixed payments for services or capital taxed as ordinary income. Like in partnerships, taking distributions reduces your equity stake in the LLC. For instance, if your equity balance is $30,000 and you take a $5,000 distribution, your equity decreases to $25,000. Carefully tracking distributions ensures accurate financial records and avoids overdrawn accounts. Corporations provide the most flexibility in how payments are classified, but they also come with stricter rules. If you're an employee of your corporation, you can pay yourself a salary. Salaries are subject to payroll taxes and must be reasonable, meaning they align with industry standards for similar roles. As a shareholder, you may also take dividends or distributions. These are taxed at a different rate and not subject to payroll taxes. When a shareholder takes a dividend, it reduces the retained earnings of the corporation, which indirectly impacts equity. For example, if retained earnings decrease due to a large dividend, the company's total equity also decreases, reflecting the reduced value available to shareholders. In S-Corp, combining a reasonable salary with distributions can create tax efficiency. In C-Corp, dividends can result in double taxation, once at the corporate level and again at the personal level, so they require careful planning. Each payment type carries different tax implications. Salaries are subject to payroll taxes, including Social Security, Medicare, and income tax withholding. Guaranteed payments are taxed as ordinary income for the recipient and deductible as an expense for the business. Draws and distributions are not subject to payroll taxes but can reduce equity in the business. They are taxed only on the business's profits, not the withdrawal itself. Dividends are taxed at the shareholder level and potentially at the corporate level in C Corp, which is known as double taxation. Understanding these distinctions helps you choose the payment method that aligns with your financial goals and tax strategy. To ensure proper classification and financial management, understand your business structure. The type of entity you operate determines your options for classifying payments. Track equity changes by keeping detailed records of how payments affect your equity balance to maintain clear financial reporting. Document agreements by clearly outlining payment terms, especially for partnerships and LLCs, in formal agreements. Seek professional advice by consulting an accountant or tax advisor to ensure compliance with tax laws and optimize your payment strategy. Classifying payments to yourself as a business owner is more than just a technical detail. It's a critical part of running your business efficiently and transparently. By understanding the impact on taxes and equity, you can make informed decisions that benefit both you and your company. If you found this guide helpful, don't forget to like, subscribe, and share it with other business owners. And as always, when in doubt, consult a professional to guide you through the nuances of payment classification.